With nearly 20 years of residential real estate experience and a passion for serving clients, the J. Proctor Group has built a reputation of excellence and professionalism. And this is the podcast where you can join us as we explore those latest trends, strategies, and tips for success in the world of real estate. Welcome back, Jeff. How are you doing, buddy?
Good. How are you?
Absolutely wonderful. Spring has hit the air, and we're off and running. Let's go into what that means, right? If anybody and everybody listening has followed some of the Instagrams, your social medias, you always post numbers there, which I think is excellent. Really up to date numbers. The last one was March 2023. We're coming up at the end of April into May here. Homes available was up 3%, homes under contract 28% up, and then homes sold 67% up. Those are telling words. Can you talk a little bit about that? What is that? Where do you see this going? Obviously, we're almost through April here, but into May. Seems strong.
Yeah, no, it's definitely strong numbers. I mean, obviously, a lot of that's coming off of the initial, slowdown with the interest rate hike. Obviously, the seasonal time of the year as well. I mean, the beginning of the year was quite slow because we just had the interest rate hike, and we're in the middle of winter here. So you're going to see those numbers always go up a little bit in terms of sales and closings because you have the secular cycle of homes, and that's usually about a 2 to 3 month cycle. So you're going to usually see those numbers go up now. Homes under contract will certainly go up because now we're hitting the spring market, and the closings are probably coming off of early Q1 of this year.
Let's look at price points, right? That's always an interesting thing. I know in the suburb that I live in, there are certain price points that move super fast. And then there are some that, are kind of maybe, we talked about this on a previous podcast, maybe some people are pushing their price points a little too high, and they sit. Talk a little bit about what our price points doing right now, burbs and in the city.
Yeah, the city is a little bit more focused on location right now. People are kind of heading to the safe haven areas of Lincoln Park, Gold Coast. West Loop has always been strong. Lakeview, Roscoe Village, Southport Corridor, Bucktown's doing well. They're just not in the fringe locations. The price points are doing well, I think. And similar to the suburbs, I think the biggest reason why is just simply the inventory. So a lot of people, I think we've talked about this before. You came off of the beginning of the year where rates had really taken its toll on the market, and people kind of backed off. They waited a couple months to wait to see if inventory bounced back. Well, there wasn't a ton of inventory at the time, and so people jumped back into the market now with price points really holding strong due to inventory limitations.
Family and I just got back from New York. We spent a week in Manhattan. I got to tell you though, even like nationwide, what the prices in the city are actually, I would think, pretty reasonable. Can you talk about, I know you travel around a lot and see a bunch of other bigger markets, in comparison with Chicago. I know this is like a left curve coming in question, but yeah, what do you see there? I still think it's pretty reasonable for what you get.
Very much so. Yeah, Chicago's definitely got a big cost advantage from the major metropolitan markets. You're starting to see, New York, San Francisco, Miami, LA. Now, if you're getting into, those are probably your top markets right now. Boston's very expensive, but you can also understand, except for LA, they're all very tight-knit markets where you have a kind of a fixed area that you really want to be in. You'll see markets such as like in Indianapolis, a Houston, or a Dallas. Prices are up certainly, but there's a wider spread of areas that you can go to. But Chicago in general, you can get into a luxury property in downtown Chicago right now for about $1,000 a foot to about $1,500 a foot. I would say on the very high end. Obviously, you take a look at that in New York, and that's probably like $4,000 to $5,000 a foot. So yeah, we're at a huge discount, I think, comparably speaking to most major metropolitan markets for sure.
And then, when we are looking at, inventory, right? It is slightly going up. Why do you think that is? Is think people are like, well, you know what? We've kind of seen what's happening with the Fed. We're coming into, the rest of maybe the late spring market where it's moving. They're getting some answers. What's going on with inventory, and where do you see it going through the summer?
It's spring market. I mean, you're always going to see inventory go up in the spring for sure. We're still having inventory issues. I would say that the demand far outweighs supply. The spring market, you're always going to see, usually the rule of thumb is Super Bowl weekend. If Super Bowl weekend doesn't take off, then you get St. Patrick's Day. And then if it doesn't happen, then you probably hit that April market when the weather starts changing. So inventories will always go up in the spring. That's where you're seeing that number. But from our experience, city and the suburbs, you're seeing demand far outweigh supply. So if something's on the market that's quite attractive and at the right price point, it's moving rather quickly.
And then we talked a little bit about the city. Price points in the burbs. What's hot, what's moving, what's not moving? Are you seeing any trends out here in the burbs?
Yeah, I would say that location obviously is always huge. Proper locations within towns. I'd say the majority of hot towns right now are major metropolitan areas major metro areas where they have access to train, they have a downtown area. We work a lot in Hinsdale, Elmhurst, Glen Ellen, Downers Grove, Naperville. Those towns seem to do well. Naperville always seems to do well, but it's a much, much bigger area, much bigger town. Whereas like Elmhurst, Hinsdale, Glen Ellen are very tighter areas to really be in. And most people want to be close to downtown. So if you're close to downtown, you're priced competitively, it's going to move. Now, we've seen a lot of property right now that honestly comes in very high on the numbers. And then we just can't really fathom the number when we look at a comparable market analysis on it. So they just sit. A lot of other properties that sit are dated properties that need a lot of work. So obviously with construction costs being up so much, you're going to see those sit because the seller wants a big number. And then when you start to equate your cost to rehab or to upgrade the property, it just far outweighs the final number. So new construction's always been selling well. For some reason, everybody always wants new, of course. But those prices have also been at a huge premium as of late due to the construction costs. So construction costs, material and labor has really been driving the new construction market. So when you start to see those premiums, somebody with maybe a more dated house of 10 years plus, they think that their house is worth that number. Well, it's unfortunately not, because more people are more willing to buy the new construction versus going into a project.
What's going on with, there was a big movement a few years back. You can kind of speak to this a little bit more about tear downs because of space, right? I mean, we're talking about places where you can walk, like a Glen Ellen, but there's only so much around it, Hinsdale, et cetera. What's going on with the tear down market? Because it used to be where people would price their house. Maybe they had a relative pass away or something. They would just price it to move it or all in, and then it would become a tear down property. Personally, I don't see that much anymore. What are you seeing in that area?
Yeah, we're still seeing quite a bit of tear downs. I mean, there's still a lot of construction. But you're not seeing as many spec homes. Let's put it that way. These are the majority of homes that are being built right now are probably like more of like a semi-spec, where they already have a buyer that's in place and they're going to build the house based on what the buyer is looking for. So kind of a semi-custom house, or a true custom house, or somebody's building, a rather large house on a larger piece of property, right? So we're still seeing quite a few tear downs. This all goes back to costs, right? And we kind of hit a little triple-edged sword, I would say here, is because simply that we have lot values that are up, we have construction costs that are up, right? Materials and labor is up. So, and then now you're playing with the interest rate game. So everything exponentially has gone up. I would revert this back to, a lot of this interest rate move, it's supposed to suppress the market a little bit against inflation, where I really don't think it's helped. We haven't seen a huge discount in materials and labor and construction costs. It's driven the inventory, although it shows that the inventory is higher. A lot of these people are not willing to move out of their houses now because they're at such a low rate to get into a larger mortgage, right? So there's a lot of factors that are going against us. It really didn't curb inflation. So with the low inventory and even with higher interest rates, people are still willing to either tear down and build if they can find a lot. But to find the right lot in the right location, you're probably paying a little bit more of a premium than you did 5 to 10 years ago. And then you're paying more on the construction cost, plus you're paying more on the carry. So everything kind of adds in. So when you see these prices, especially at new construction levels, you know, I'll use Elmhurst as an example. I mean, I remember new construction pricing being $975. Now you're talking 1.3, 1.4, and people don't really understand that fact. When you put all those, you know, factors of construction costs and lot value back into it, I mean, they just can't build it for anything less. So unfortunately, we're just at a tough time in the economy, just because all the factors should say that the market should be suppressed, but even though the interest rates have come up, it really suppressed the inventory, which really didn't depress the market at all.
That's kind of answering my next question, you know, thinking about the downers. And, you know, I think we've been in this area long enough to where, you know, we saw Elmhurst, how it kind of moved into, you know, the home values rose, the new construction rose. And then you also have the pricing and the worth of those homes are rising. I'm seeing something a little bit like that in kind of outskirts. So I'm in the, you know, LaGrange area where, you know, they've already kind of done that, but there's still some left where there's smaller homes. And then there's builds. I think Downers Grove is another place. Are you seeing like people? So if they're going to look at a home that is 1.5 in Elmhurst, and they're like, well, if I can build it for $1 million in Downers, are you seeing any of that? Because I see it here in Brookfield, Riverside area as well.
Yeah, that's, you know, I think that's a driver of each area, right? So I would say like the Hinsdale, Clarendon Hills market is probably the most expensive. And then you get probably, I would say, a $300,000 to $400,000 to $500,000 discount moving into Elmhurst. You get a little bit more of a discount moving into Glen Ellen, and then you get a little bit more of a discount moving into Downers. So each one of those areas has different price points, and I think that's for the main areas that we work on. I think that's kind of the quadrant that people go, because they're trying to find out what they can afford and where. I mean, I first moved out to, or was looking at the Western Suburbs, I looked in Hinsdale, and simply I couldn't afford it for what I could get for the value. I could afford it in Elmhurst, but I couldn't afford it in Hinsdale. So that's really the driving factor. Hinsdale is definitely the higher end. Western Springs, I would say, is probably comparable to like a Clarendon Hills. And then LaGrange, Oak Park and Park Ridge probably are very similar. That's running north and south. And those kind of run in the similar price points because they're similar downtown areas. They're similar type of construction because you got a lot of older homes. Obviously, the further west you move is you're going to get newer construction. And then if you go all the way out to Naperville or Geneva is really hot right now. I mean, Naperville is such a large, expansive area. I mean, there are developers buying up lots left and right out there and just holding on to them until they can find the right owner to build.
Well, we'll see what happens coming up here in the summer. Any final thoughts on going into May and onward into the summer?
I think we're going to keep running into the same components. I mean, I think we really are. I mean, we've been saying for years we would have more inventory. We're waiting on inventory. And it just really hasn't come. I mean, if you look at this is coming off of the 07, right? I mean, this is 07, 08 was okay. 2010 was probably the biggest down time in the market. Then you had 11 and 12. You really didn't see construction starts till 13. And then you start moving into 13, 14, 15, and you weren't seeing a ton of spec builds. So you weren't seeing as much construction as you once were. Obviously, money was cheap, but the lending was just quite different at the time. And then we hit COVID. So then we hit the COVID time, and then now we hit this interest rate time. I mean, I think we're going to see more of the same. Low inventory, prices are going to hold up unless something catastrophic happens in the world. I think that's pretty much what we're going to see.
Well, I appreciate your professionalism and your insight into the market. And I know our listeners do too. Thanks, Jeff, for hanging out with us today.
Thanks, Pete. Appreciate it.
That's all for this episode of the J. Proctor Property Podcast. We hope you found the information and insights we shared to be valuable and informative. As a reminder, the J. Proctor team has nearly 20 years of residential real estate experience and a passion for serving their clients. Jeff and his crew is committed to providing best-in-class expertise, marketing, technology, and service to help you navigate the ever-changing real estate market. If you have any questions or need any additional information, please don't hesitate to reach out. You can email Jeff at jeffproctor@properties.com or give him a call on his cell. He's always in his office, 773-517-6026. We're here to help and support you on your real estate journey. And don't forget to tune in next time for another episode of the J. Proctor Property Podcast. Thanks for listening.